Hello and welcome to the October 13th, 2023 episode of Watching the Tape. Bonds don't get a lot of airtime on the major financial news channels. There's a perception that they're just not as glamorous as stocks, and bond pricing can be a little complicated at times, so why bother? You do, however, hear a lot about interest rates, which are, of course, directly linked to bonds, but the conversation about interest rates rarely, if ever, covers the impact on bond prices. In this video, my goal is to really drive home the relationship between interest rates and bond prices using a real-world example that is so extreme that I'm confident you won't forget it. Experience is the best teacher, so let's see if we can get as close as possible to experiencing the price change in a very real treasury that was issued 3.5 years ago. For this exercise, I want you to turn back the clock to May 2020, at which time you bought a brand new 30-year treasury bond. This bond was issued with a 1.25% coupon or 1.25% interest rate. And let's say you bought 100 of these bonds and each bond is $1,000, so your total investment at the time was $100,000. You proceed to tuck away your $100,000 investment in your portfolio. You're set to collect a coupon of 1.25% or $1,250 in interest income annually over the next 30 years. And then at maturity, you get your principal value back of $100,000. U.S. Treasuries are the safest bonds out there. This is the end of the story, right? Not exactly. The price of that treasury bond changes every minute of every trading day based upon interest rate movements. So what has happened to interest rates since you hypothetically bought that bond in May 2020? Well, interest rates have gone up a lot. Today, in our scenario here, you hold 100 treasury bonds with 26.5 years remaining to maturity. Still paying you $1,250 each year, but let's say you have to sell out of your position. The prevailing interest rate on 26.5-year treasuries today is just a hair over 5%. So what has to happen to the price of your bonds in order to get someone to buy them from you? The bond price has to go down a lot. Why? Because a buyer would only be willing to pay a price that would result in an annual return of 5% for the remaining life of that bond. The actual market price for this particular bond is 45% of the price paid 3.5 years ago at issuance. Here is the price chart going back to that issue date in May of 2020, and it shows the subsequent fall in bond price since then. From the buyer's perspective, they're getting 100 bonds for $45,000, which will pay them $1,250 in interest annually going forward. Well, if you divide $1,250 by $45,000, that's a current yield of only 2.78%. That's not 5%. The remainder of the annual return will come from the bond price appreciating back to par or 100 at maturity. So from 45 now to 100 at maturity over the next 26.5 years, that's where the remaining portion of that return comes from. Treasuries are widely regarded as risk-free assets, and while there may be no perceived risk of default, there is still plenty of price risk, and the longer the time to maturity, the greater the price risk. If you were to instead have held a 1-year treasury with that same 1.25% coupon, and you had to sell it today, a year before maturity, well, if the buyer required that same 5% yield, the price on that treasury would work out to about 96.5. So not nearly as bad as the 45 that we saw on the longer term bond. That is it for this week. If you found this video helpful or interesting and can think of anyone who might benefit from the content, please share it. Thanks for watching. We'll see you in 2 weeks.